Watch your cash balances. Too much cash will put you on a naughty list because inflation will erode and destroy the purchasing power of that cash. And it's not just the purchasing power. Most people need to take on risks to meet goals. You need that return above inflation to last you 30 years. Bottom line, if you're investing too conservatively or too much in cash and you don't have clarity on what the cash is for, a lot of times it's not a good or bad decision, but it's that you're not making an informed one. You park the money in cash, maybe out of fear, paralysis from analysis, and you're not able to meet your goals. You're not keeping pace with inflation. You're not getting the return above inflation that you need.
Welcome to the Healthy and Wealthy Retirement, where your certified retirement counselor Mark Struthers takes a holistic approach to retirement, going beyond finances and embracing holistic well-being. This YouTube channel will address not just the financial part of retirement, but also the social, the physical, and the emotional parts of retirement. Everything you need for healthier, a wealthier, and a happier retirement.
Welcome to the Healthy and Wealthy Retirement. My name is Mark Struthers, and as you can tell by this fairly ugly sweater, it's Christmas time. And today we are going to do the retirement naughty and nice list. Everyone worries about doing retirement wrong, about making mistakes. Unfortunately, they don't start worrying until it's kind of the night before. It's like pushing off a final. But most mistakes when it comes to financial planning or even retirement aren't bad intentions. They're bad defaults. They are mistakes of not making some effort to make an informed decision. So we're going to run through some naughty and nices. What gets coal and what gets a bonus. And coal seems so outdated. I don't know what the modern equivalent of coal would be, but we need to change that. If you have any suggestions, put them in the comments section. So how this works, it's about behaviors, not people. Almost everyone has items on both lists. No one's perfect. The goal is to listen to some of my naughty and nice suggestions. And if you see your list name on the back, remember it's not final. You still got a couple weeks till Christmas. Not too late to change Santa's mind. So the goal is to take some of these and try to move a few from the naughty list to the nice list. Number one on the nice list, a real retirement spending plan. It doesn't have to be a perfectly tight budget, but you need a rough idea of what you're going to spend and giving you permission to enjoy your retirement. A clear view of needs, wants, and joy spending. This financial planning, like going to the dentist, isn't about some sort of punishment. It's about being the healthiest version of yourself. Now, when you're there, it's not the most fun, but once you get through it, you enjoy life better. When you spend some time on your spending on your retirement plan, it gives you flexibility. You know what's coming. It's not going to be perfect. Even when we have those who just down to the penny track. And tracking's good. Life happens, especially when it's not just you. If there are spouses or kids or relatives or just external factors like inflation, like we had a few years ago. When you have a real retirement spending plan, again, don't let the perfect be the enemy of good. It can reduce anxiety around, can we afford this? It allows you to enjoy retirement. Some people kind of put it to the side. They say, well, I won't worry about it when the time comes. It's different when you're in retirement. It just is. My son who just finished his first marathon, you can do all the training in the world, and he'll even tell you, the more I prep, the better chance of having a race day, but it's always different when you're actually running the race. Number two on the nice list, having some sort of guardrails / green light spending. We call it green light spending at Sona, where spending adjusts with markets, not emotions. Because markets, inflation, and all these things are dynamic, the idea that you are not adjusting them, both to spend more when things are good, spend less when things are bad, is not making the most of your portfolio. We talk about this in some detail. When you do this, When you do this, almost always you are able to spend more in retirement because you are willing to make these small adjustments. It also avoids panics during downturns. You know what to expect. You know what you might have to do. Number 3, tax planning before retirement. Using low income years intentionally. It doesn't mean you have to do what many people like me suggest. Often it's Roth conversions. It might be taking distributions, but doing some kind of tax planning, because you have to factor in Medicare as well. That Medicare surcharge, we'll call it a tax. So doing Roth conversions, understanding your required minimum distributions, coordinating all those accounts with withdrawals, with your goals. Are you going to buy that pontoon? Where are we going to take the funds? That new car, that dream car. Where are we going to take the funds? What does it look like overall? Not just in the next year or two, but what does it look like 10, 15 years from now? Quite often what you find is folks who, they're making an informed decision. So a lot of folks say, you know what? I hear you, Mark. I know the Roth would be great to have. I know I should use up these lower tax brackets, use up my standard or itemized deduction. I know I should take advantage of these things, but I don't want to. I don't want to take a chance on not living long enough to enjoy the tax benefits. I'd rather just pay less tax in the short term. It's an informed decision. When we model it in and we say, you know what, you would have X amount of dollars more if you live this long and these assumptions all come to be. If you're okay with that, yeah, but you're making that informed decision. You're not guessing at the monster under the bed. You're looking underneath the bed, shining the light and saying, you know what? I'm okay with all this. So it's about making an informed decision. And when it comes to tax planning, you really do have to do it in advance. And also part of that is just knowing what taxes you might pay. Here in Minnesota, there's a big debate over the Affordable Care Act tax credits. So, before Medicare, that's a factor. Knowing that in retirement, when you have Medicare, that you might have that surcharge, and that has to be done, planned a couple years in advance. And it's a cliff type situation, not a phase out. Things like Minnesota's property tax rebate. Knowing potentially what all those taxes are, both in the short term and in the long term, will help you make a better decision. It'll help you stay on the nice list. Another way to stay on the nice list is estate and beneficiary alignment. So using things like trusts, TODs or PODs, transfer on death, payable on death. Updating beneficiaries. Make sure that you get as much as you can captured so that your wishes are known. And for some people, it's about making things easier on their heirs. If you do nothing and the state has to probate things, and keep in mind, I don't want to this isn't designed to get too far into the estate planning weeds, but everything in the will has to be probated. So it's about taking a little bit of time, even if you're not going to pay for a trust, even if you're not going to get super complex, to say, kind of like with financial planning, retirement spending, what have you, is knowing what possible outcomes are, knowing what might happen to your spouse or your loved ones, being aware that if you're kind of like Prince, I live in Chanhassen. Many of you know we often work out of Edina or downtown Minneapolis, but I'm from Chanhassen. Prince's place is not far from here, and he kind of left things a mess. He really didn't define anything. So it depends on what you want for a possible outcome. If you're someone that truly said, I'm okay with just letting things go, then be aware. It might not turn out as well for your heirs as you might think. You could get lucky. The last thing on the nice list is investing with a purpose. It's about being intentional. Again, we circle back to making an informed decision. If you want to be in that nice list, most often it's not about good or bad decisions. It's about being intentional. When it comes to investing, risk should be tied to life goals, not to market predictions. Diversification across time and tax buckets. Knowing what asset to have in what account type is a way you make more of your hard work, make more of what you have saved. Also, assuming markets will misbehave, being aware that the stock market, the bond market, it's not a chess game, really. It's more like poker. There is emotion and luck involved. And especially in today's world where you have more retail traders, for good and bad, you have more computer trading, quant trading. You have short dated options, and you don't have to know what those are, but those can move markets and have nothing to do with fundamentals in the short term. You also have governments being more and more involved. The market is holding its breath every time you have a Fed decision. You have governments more and more buying assets, spending, inflation, tariffs. So you got to realize going in that unless you are intentional about your investing and the way you take on risk, you might not be prepared to handle it number wise, but also emotionally. Your investing should be designed to support your spending. So again, that's why we use green light spending here, so we use guardrails. So it's about making sure your retirement is as good as it can be and as safe as you want it to be. So it's about supporting spending, not beating an index. All right. Next up, we have the naughty list. The naughty list number one. And this one is an interesting one because when people do this, they often think they're doing the right thing. The intentions are good, but blindly using the 4% rule. The 4% rule was a fantastic rule. Was it about 30 years old, 30 plus? And we've often talked about the problems with the 4% rule, and we often highlight it, and it is a good guideline, but that's what it is. Many people treat it as a guarantee instead of a guideline. So realizing the dangers of your 30-year or more retirement, the sequence of returns, the way the 4% rule, and ignoring market conditions, ignoring spending flexibility, that if you have that, it allows you to spend more throughout your retirement. It just does. I think about literally thousands of scenarios we've run. At one point, we had a pretty big employee financial well-being side of the business. So we were working with hundreds of clients at companies. And only granted, we might not have gotten too deep into a lot of their planning, but we would run scenarios. And when you have a flexible spending schedule that responds to market conditions, overall in retirement, I don't think I've seen any of them where you weren't allowed to spend more. Retirement should not be a math problem, meaning we need to try to make sure you enjoy retirement. We want to make sure you have that level of safety, that the probability is not just that you won't run out of money, but that you don't die with too much. And given most of the dangers when it comes to the 4% rule have to do with the first 7 to 15 years, 7 to 10 years out of retirement, I'll use the word silly. I think it's silly that more folks don't embrace what we call green light spending. Don't embrace some sort of flexible, dynamic spending schedule because it does allow you to spend more and it does allow you to enjoy. Number 2 on the naughty list, and this is actually a big one, and this happens to folks not just in retirement, but overall, cash with no job. And I'm not talking about Johnny Cash, the man in black. I'm talking about large idle cash balances. I see this a lot with successful professionals where it just builds up. Now, in the past few years, with shorter term rates being between 3 and 4 and 5%, the harm hasn't been that great, especially when for a few years there where you had high short-term rates, high money market cash-like rates, and lower inflation, because your real inflation wasn't eating away at your cash. But that scenario, as you see it's changing, doesn't last very long. So when you have large cash balances, you're not putting yourself in a position to succeed. It's often fear disguised as conservatism. People are afraid, and I don't mean it afraid as if they're cowering in a corner sometimes, but quite often they're not entirely sure what to do. So the easiest thing is just to have it go to cash, and then momentum takes over. Now, some people, it's truly, they are terrified of the stock market. It's nothing to be ashamed of. It's not, sometimes, especially with men, there's this machismo. I like risk. Well, it's kind of like when my son was a year and a half ago, summer of 2024, we were jumping off a fairly high cliff in Hawaii. And a lot of people wouldn't jump in. Now we do it in a safe way, but there is no harm, there's no shame in saying, I don't like that. That's a risk I don't want to take on. I don't see the value. So you shouldn't just blindly invest in risky assets to be the tough guy. Since it's Christmas is coming up, we'll use Bruce Willis in the Die Hard movie. And Die Hard is a Christmas movie. I'm going to say it again for when they clip this up. Die Hard is a Christmas movie. But you don't have to be a gun-toting, yippee-ki-yay Bruce Willis to do a good job with your retirement. So watch your cash balances. Too much cash will put you on a naughty list because inflation will erode and destroy the purchasing power of that cash. And it's not just the purchasing power. Most people need to take on risks to meet goals. You need that return above inflation to last you 30 years. Bottom line, if you're investing too conservatively or too much in cash and you don't have clarity on what the cash is for, a lot of times it's not a good or bad decision, but it's that you're not making an informed one. You park the money in cash, maybe out of fear, paralysis from analysis, and you're not able to meet your goals. You're not keeping pace with inflation. You're not getting the return above inflation that you need. So don't let fear dictate what you do. Number 3 on the naughty list, and this is a big one. I just helped out Bloomberg Wealth with a piece on NVIDIA, but it was number 3 is chasing the hot investment. What we talk about FOMO. FOMO, fear of missing out driven decisions, which forces a lot of retail traders and institutional traders as well to buy when prices are high. You see a lot, what I view as a lot more volatility in the market because you have all these short-term things. You have people who are honestly not investing, they're trading. And quite often it is retail traders, especially those who are doing short-dated options, but fear of missing out. So you get on the naughty list because you're trying to chase the recent fad. You let concentration sneak into your portfolio, even if it's at the index level. Many people will just put money in the S&P 500. Buffett has said it, and Buffett is very wise. But if an index, any index, gets too concentrated, you can have years and years of underperformance. If you wait long enough, and history has shown, will it come back? It will. I mean, the performance of the S&P 500 is there. But you do have lost decades. 2000 to 2010 for the S&P 500. Look it up. It's easier now than ever. Lost decade. You look at those folks in Japan and talking about Die Hard. Again, Die Hard is a Christmas movie. I'm going to say that a lot. Die Hard is a Christmas movie. Die Hard has the destruction of Nakatomi Plaza. And for me, it kind of signaled the end of Japanese dominance. See, in the 80s, everyone was terrified of Japan, or they had great respect for Japan. Japan was dominating everywhere. And it was shown in that movie. That was a Japanese company that was building that skyscraper. But then Japan, the Nikkei, their main index, had not just a decade, had more than a decade that was lost. So getting too concentrated, chasing too many hot investments, individual stocks, you see it, especially in retirement. If you're younger in your 20s and you have literally a decade or two to come back, there's less long-term harm because you do have time to make up for it. But when you're in retirement, the predictability is huge. You have more predictability when you have some diversification. Doesn't mean you can't take on some risk. Doesn't mean you have to own what exactly every broad index is. No index is perfect. But it does mean if you're diversified, especially across countries, you're going to have more predictable returns. You're not going to hit as many home runs, but you're going to hit a lot more of the doubles and triples. You're going to have more predictable growth and outcome rather than if you go concentrated. Number 4 on the naughty list, ignoring healthcare and long-term care. Less and less so, but for a long time, it seemed like people would just say, well, Medicare will take care of it. And Medicare certainly is going to pay for a lot. It's hard to believe it ever goes away, but you're going to have more and more cases in some sort of means testing, and you see it with the Medicare surcharge tax, that there's going to be additional costs for healthcare, and you should try and plan for it as best you can. And then long-term care. Long-term care can be huge. And again, it's not about saying you have to have long-term care insurance. There's downsides to long-term care insurance, a lot of them. But it's about being aware of possible outcomes. Again, it's being intentional, making that informed decision to say, if we have a really bad long-term care episode where we could spend $200,000 a lot, but it's possible per year. Usually if you get up to that amount, you often don't live very long. And that depends on where you live as to how much the cost is. But you take something that's more mental, dementia, where the care is very high, especially if there's a fear of harming yourself, where I've seen it in myself, where it can be $250,000 a year here in Minnesota. Real life example. And if it's a case where it's less physical, it's more mental and physical, they could live for years. Should you go out, do you have to plan your entire retirement around it? No. But it's about saying that's a possible outcome. Can we do anything to deal with that when we're in retirement, but still enjoy our life, still spend enough to where we want to enjoy our retirement and still in some ways plan for it. So it's not about saying you have to do one thing or the other, but it's about making that informed decision that'll keep you off the naughty list. Number 5, the last thing people do to get on the naughty list, treating retirement as the finish line. Meaning some folks get to retirement, whether that's 62, 67, 70. You see more and more people who do some kind of retirement in their 50s. But what you often run into is once they really put thought into it, they realize they need to plan for their time, their purpose, their identity, and some income. Unless they are really planning to only live for another 10 to 20 years, which is possible, they usually need to plan for something additional. And I can't stress enough, planning for time, purpose, and identity, to go from, especially if you have kids, to go from your job and your kids, especially, and with kids, you throw in the team and traveling sports, to go from having very full weeks to having very little. And it's not everyone. There's some folks who they have so much going on. Their retirements, I think, are busier than when they were working, but often you don't. And again, it's about making an informed decision. It's about trying to increase the probability of a good retirement outcome. So that means not just financially, and assuming happiness is just going to show up. That retirement's that finish line. Once I cross it, it's nirvana on the other side. Happiness is there. That finish line, that retirement is just a start, especially for Gen Xers or younger, where you could be spending the same amount in retirement as you did working. And people will often acknowledge that they hear me when I say that, but really let that sink in. Even if it's not the same amount, it's often close. If you spend 40 years working, and sometimes if you were laid off, you could even subtract a few years all in between jobs or something. But the idea that you have 30 years in retirement out of a 70-year adulthood, that's a lot. And it could even be equal depending on how long you're going to live. So even if you plan for all the money scenarios, even if you say, I'm going to be properly invested, I'm going to use the SONA Mark's green light spending, I have got control over the numbers and the investing and the taxes and everything to where you're making the most of your portfolio and your money. Money without meaning only lasts for so long. And it's not that money doesn't matter. Money can make misery a lot more comfortable for a lot longer. But if any of you ever talk to those that are fairly wealthy, what you see is true. That after a certain point, money does not buy happiness. There are a lot of miserable people who are ultra high net worth. So make sure that you don't treat retirement as a finish line. Make sure you're prepared for the non-financial piece of things. To wrap things up, as I send you on your Merry Christmas way, most people are not naughty or nice. They're just uninformed. They're just They don't act with intention. And especially pre-retirement, that's understandable. You look at how busy we are, especially around the holidays. Remember that you don't need perfection. Don't let the perfect be the enemy of the good. And that being said, even my list, if you can just move one or two of those to the nice list, take some time. And you don't even have to make a decision and act right away, but let some of these things sink in, and you'll find yourself making some of these decisions just because you're putting a little more intention, a little more thought, you're a little more, and you will build confidence. It will compound. So if all this resonates with you, please like and subscribe, comment. If any of you have some things that should be on the naughty or nice list, or you disagree, please comment. And the main takeaway from being on the naughty or nice list, as you can tell, is about being intentional. The more intentional you are with your actions, both financial and non-financial, with your family, the better chance you're going to have of having a healthy and wealthy and happier retirement. Don't forget to hit subscribe. Thanks for tuning in. If you enjoyed this episode, make sure to hit subscribe, leave a review, and share with your friends. Share the love. Make sure they have a healthier, a wealthier, and a happier retirement as well. Also, don't forget to subscribe to our newsletter for free resources and check out our website and social media pages for exclusive content and updates. See you next time.
Sona Financial, LLC, DBA Sona Wealth and Sona Wealth Advisors, is a registered investment advisor with the state of Minnesota. All views, expressions, and opinions included in this communication are subject to change. This communication is not intended as an offer or solicitation to buy, hold, or sell any financial instrument or investment advisory services. Any information provided has been obtained from sources considered reliable, but we do not guarantee the accuracy or completeness of any description of securities, markets, or developments mentioned.